Thanks for clicking! Canadian fixed mortgage rates just got caught in the crossfire of a major bond sell-off in the United States. That is, until President Trump blinked, pausing reciprocal tariffs for 90 days. Yeah, while Canadians saw the yields on government bonds, which dictate fixed mortgage rates, spike 30 basis points, or 0.3% in just a matter of days, it was worse in the United States, where yields rose almost 60 basis points, as the Bond Vigilantes sold off US Treasuries in response to the escalating Trump tariff war. Yeah, and we've talked about the Bond Vigilantes before on this channel. Those vigilantes, those investors who sell government bonds in response to fiscal policies they view as inflationary or irresponsible, driving up borrowing costs for the government. And on Monday, Tuesday, Wednesday, they were out in full force, selling off US Treasuries, with some even starting to argue that the Federal Reserve might have to intervene, turn on the money printer, and buy up US debt. Even the president himself, in the aftermath of the crisis, in his own way, kind of admitted the power of the bond market.
It's beautiful. The bond market right now is beautiful.
We're all fine. Everyone's fine.
And this obviously has a number of implications for the rest of us, Canada included, as the bond market has finally done what no leader, no elected official was able to do. Check President Trump. So what I want to do today is very briefly go over how the Bond Vigilantes work, take a look at how they worked their magic on Wednesday, and then discuss some implications. As we'll see today, the market during this uncertain time is working in uncertain and fascinating ways. We'll obviously continue to track how this all plays out and most importantly how it affects us here in Canada on this channel. Make sure you click like and subscribe to get those updates, but for now, let's get into the Bond Vigilantes. Onto the Bond Vigilantes. First off, how exactly do they work? Very basically, a bond vigilante is a fixed income trader who sells bonds, or threatens to do so, to push back against specific policies of the issuer, in this case, the US government. And for this, it's worth very briefly recalling for our non-regular viewers that a bond's price and its yield are inversely related. Say I have a bond that I purchased for $100 that is going to pay me back $110 at maturity. That bond is yielding 10%. But let's say I don't want that bond anymore. I don't want to wait until that bond matures as inflation is rising, and I know that when I get that $110 back, it's not going to be worth nearly as much in real terms as it is right now. I won't be able to buy as much with that $110 due to irresponsible government policies. So I decide to sell that bond to Jen, who is willing to wait for that maturity, but she's only willing to wait for a price. Jen pays me $95 for that bond. I get my money now. I don't have to worry so much about inflationary risk. Jen's going to wait that out, but she is going to yield much more than I did. Paying only $95, she is now yielding 14.6% on that bond. So we can see that a bond's price and its yield are inversely related. The bond price dropped, the yield went up. The amount of money that Jen is going to earn on that bond increased. And this is where the bond vigilantes in the United States come in, as a group of bondholders, investors, hedge funds, etc. opted to sell off their bonds all at once, putting massive downward pressure on the price, causing the yields on those bonds to surge. We saw something very similar with Liz Truss in 2022 when she put forward a budget that the bond traders thought to be irresponsible. The bond traders sold off their UK bonds, or gilts, causing prices to crash. As Economics 101, when the supply of something increases, its price will drop. As a result, the yields on UK gilts skyrocketed 140 basis points, or 1.4%, in the period of about a month, sending UK borrowing costs surging higher. See, when the yields on current bonds surge, it's a problem for current governments that need to borrow more money. As if I'm an investor, why would I lend more money to the government, say for 10 years at 4%, when I can buy a current bond for, say, 9 years at 3.95%. And that's exactly what happened this week to one of the world's biggest debtors, the United States, when its bonds started selling off en masse, sending yields on the 10-year Treasury skyrocketing nearly 60 basis points within a few days. And to put that into context, US Treasuries haven't sold off that fast or yields risen that quickly since October of 2008, during the height of the global financial crisis. And it wasn't just US borrowing costs, this spread into the yields on Canadian bonds as well, with our yields jumping nearly 30 basis points within a period of 3 days, 0.3% in less than a week's time.
You don't do something, I gotta question your leadership.
And this was very rapidly approaching crisis levels before Trump's about face, with calls for the Federal Reserve to step in vis-a-vis asset purchases, meaning the Federal Reserve would have had to start printing up money again to buy U.S. bonds, which would have put upward pressure on their price, sending yields back down. Then, after Treasury Secretary Bessent made the announcement that the U.S. would be suspending or pausing its reciprocal tariffs for 90 days, yields started to calm down a little bit. For his part, Trump himself, in his own way, quasi-acknowledged the role that the Bond Vigilantes played in reversing his decision.
Beautiful. The bond market right now is beautiful. But yeah, I saw last night where people were getting a little queasy. I think everything had... Well, the big move wasn't what I...
And this was just a very wild swing. We had seen the yields on the 10-year plummet over the past few weeks on these Trump tariff worries, and the US Treasuries playing their traditional role as a safe haven asset, and even Canadian mortgage rates were benefiting from this uncertainty. And then on the ratcheting up of tensions with China, the bond market had just had enough, dumping U.S. Treasuries and raising serious concerns about the role of U.S. bonds as a safe haven asset during this uncertain period. And while yields have sort of settled, there are some longer-term implications emanating from this crisis. First, real damage could have been caused very, very quickly on all of these tariff back and forth threats. The $29 trillion U.S. Treasury market is the so-called bedrock of the world financial system, meaning U.S. Treasuries are used as collateral for all different types of loans. When they start to lose their value very quickly, that can equally as quickly cause cascading problems, like we saw with Silicon Valley Bank. Second, this is real damage being done to the reputation of that bedrock financial asset, with Deutsche Bank writing before the Trump about face that the market had lost faith in U.S. assets. Third, this very well might not be over. The market just demonstrated to China, the second largest holder of U.S. Treasuries, the kind of power that it has, with China able to dump U.S. Treasuries as a policy retaliation should it deem that fit. Though it probably won't, as that would cause massive problems for China as well in the global financial system as a whole. But in this environment, never ever say never. Fourth, and finally, most important for our purposes, how do you plan, how do you do business with these kind of gyrations, with this incessant volatility? How do you make plans for the future when everything is changing on a day-to-day basis and these rising costs filter their way into the cost of doing business and the cost of living? For Canadian households, how do you make these decisions to lock in your interest rate or not when interest rates can rise or fall 0.5% in the period of just 3 days? There was widespread talk of a Fed rate cut during that period, which would have given the Bank of Canada more room to cut rates as well, though that has dissipated in just as much time.
Interest and it's gone.
This kind of volatility puts real stress on Canadian consumers, those looking to either A, renew their mortgage, or B, take out new loans. I had done a video posted right before this all started on Monday, going over how the U.S. Treasury was being used as a safe haven asset amid all this uncertainty, sending borrowing costs down, which at the time I posted it was true. But as this episode clearly shows, things can change very, very, very rapidly in this uncertain environment. But my message still stands: in this environment, stay cautious, stay safe. If you're on the edge, if a big swing is going to hurt you, if you could lose your job, consider locking in. If you're in a good spot, consider rolling the dice, as borrowing costs very well could come down for at least the next 90 days or the next 5 days, who knows. So for right now, things have calmed down, but the president has drawn the ire of and caved to the bond market. Whether or not this will lead to a more cautious president moving forward remains to be seen, but we will obviously continue to track how this unfolds on this channel. Make sure you click like and subscribe if you want to get those updates, but for now, thanks so much for watching.